Welcome to Wealthfinity, your go-to channel for all things related to personal finance and wealth management. Today, we're going to dive into a topic that affects us all: inflation. If you've ever wondered why prices seem to keep rising or why your savings account doesn't seem to grow as much as you'd like, then you're in the right place. In this ultimate guide, we'll explore what inflation means, how it's measured, and what you can do to protect your finances against its effects. Whether you're a seasoned investor or just starting to take control of your finances, understanding inflation is crucial for making informed decisions about your money. So let's get started. Inflation is a term that we often hear in the news and media, but what does it actually mean? In simple terms, inflation is the rate at which the prices of goods and services in an economy increase over time. It can be a major concern for individuals, businesses, and governments alike, as it can have a significant impact on the value of money and the overall health of the economy. There are many factors that can contribute to inflation, including changes in the supply and demand for goods and services, fluctuations in exchange rates, and changes in government policies such as interest rates and fiscal policies. When there is an excess supply of money in an economy, it can lead to an increase in demand for goods and services, which can in turn lead to higher prices. Inflation is a crucial concept that affects every aspect of the economy, including the financial well-being of individuals, businesses, and governments. It's a term that is frequently used but not always well understood. This video aims to provide a comprehensive understanding of inflation, its definition, and examples. What is inflation? Inflation refers to the increase in the price level of goods and services over time, resulting in a decrease in the purchasing power of money. This means that the same amount of money can buy fewer goods and services than before. Inflation can be measured by tracking the changes in the Consumer Price Index, CPI, which is a basket of goods and services that represent the average household's expenditure. The CPI is used to determine the rate of inflation, which is expressed as a percentage increase in the price level over a given period. What causes inflation? Inflation can be caused by various factors, including increase in demand. When there is an increase in demand for goods and services, it can lead to a rise in prices due to the limited supply of goods and services. Increase in production costs. When the cost of production increases, producers tend to increase the price of their goods and services to maintain their profit margin. Increase in money supply. When the government increases the money supply in the economy, it leads to a rise in prices as there is more money chasing the same amount of goods and services. Decrease in supply. When there is a decrease in the supply of goods and services, it can lead to a rise in prices as the demand for these goods and services is higher than the available supply. Examples of inflation. Hyperinflation. Hyperinflation is a rapid increase in the price level of goods and services, often caused by a significant increase in the money supply. One of the most notable examples of hyperinflation is the German hyperinflation of the early 1920s, where the price level increased by more than 1 trillion times in just a few years. Moderate inflation. Moderate inflation refers to a steady increase in the price level over time. For example, in the United States, the average rate of inflation has been around 2% per year in recent decades. Deflation. Deflation refers to a decrease in the price level of goods and services over time. Deflation can occur due to a decrease in demand or an increase in the supply of goods and services. An example of deflation is the Japanese economy in the 1990s, where the price level decreased for more than a decade. Inflation can have various effects on different aspects of the economy, including interest rates. Inflation can lead to an increase in interest rates as lenders may charge higher interest rates to offset the decrease in the purchasing power of the money they lend. Wages and salaries. Inflation can lead to an increase in wages and salaries as employees demand higher wages to keep up with the rise in the cost of living. Investments. Inflation can have both positive and negative effects on investments. Assets such as real estate and stocks may increase in value during inflation, while cash holdings may decrease in value due to the decrease in purchasing power. International trade. Inflation can affect international trade as it may lead to a decrease in the value of the domestic currency, making exports cheaper and imports more expensive. Governments and central banks use various tools to control inflation, including monetary policy. Central banks can adjust interest rates and the money supply to control inflation. Fiscal policy. Governments can adjust taxes and government spending to control inflation. Exchange rate policy. Governments can adjust the exchange rate to control inflation by making imports cheaper and exports more expensive. Inflation is a critical concept that affects various aspects of the economy. Understanding its causes and effects is crucial for making informed financial decisions. Governments and central banks play an essential role in controlling inflation, but individuals and businesses can also take steps to mitigate the impact of inflation by adjusting their financial strategies accordingly. Keeping an eye on the inflation rate and its potential impact on different aspects of the economy can help individuals and businesses make informed financial decisions. In conclusion, inflation refers to the rise in the general price level of goods and services in an economy over time. It is caused by various factors such as increased demand, reduced supply, and changes in government policies, among others. Understanding inflation is crucial for individuals, businesses, and policymakers as it affects their decision-making processes. By monitoring inflation, governments can implement policies to control it and maintain stable economic growth. It is also important for individuals to take measures to protect their assets and investments from the negative effects of inflation. Overall, with the knowledge provided in this ultimate guide, viewers can now better understand inflation and its impact on the economy.